Hello and welcome to today's video brought to you by Enigma Traders. Today we'll be discussing the fair value gap, an important concept for traders to understand. The fair value gap is defined as an instance where there are inefficiencies or imbalances in the market, which implies that buying and selling are not equal. We will discuss what the gap means, how to find it, how to place trades using the fair value gap, and some indicators for it on TradingView. To understand the fair value gap, let's first take a look at a chart example. In this image, you can see there is strong selling pressure where the rectangle is drawn. A fair value gap happens in a 3-bar sequence, which is indicated by the gap between the wick of the first candle and the wick of the third candle. It is important to note that the fair value gap is only considered the gap between the wicks and not the actual body of the candle. In the same 5-minute chart as shown before, you can see the gap was filled the next day. The gap is an indication that at some point in time, the market will come back to fill that gap. This can happen in seconds or even days, but it is important to note that the balance will always be filled. These gaps are typically all over the charts, but it is recommended to find sizable gaps and not use every single little gap that you come across. One strategy that traders can use when trading the fair value gap is to use these gaps as targets for taking profit. For example, if you take a long position at a support below the fair value gap, there's a good chance that the trend will play out to the gap and you can use that area to close out your positions. The opposite holds true for resistance levels if you want to open a short position. On TradingView, there are many fair value gap indicators available. While you technically don't need an indicator as you can gauge it with your eyes, some traders may prefer to use an indicator to help them identify fair value gaps. One of the more popular indicators is the ICT fair value gap indicator. This is known for its accuracy and simplicity, and you can choose how many gaps you want showing at any time in the settings feature. Another strategy you can use when trading is to take a position when price comes back into the fair value gap at the halfway point. This strategy involves riding out the trend and taking profit at the next box. For example, take a long position when price drops back into the green gap and take profit at the red block. It is important to note that the green and red boxes are not areas of support and resistance and should not be treated as such. They are gaps created due to market inefficiencies. In conclusion, the fair value gap is an important concept for traders to understand as it provides insight into market inefficiencies and potential trading opportunities. By understanding the fair value gap, traders can use it as targets for taking profit and as a way to identify opportunities to enter or exit a position. I hope you found this video helpful. Please subscribe and leave comments for any videos you'd like to see in the future. Thanks for watching.